Hi, everybody, and welcome to our very first episode of our brand new investor playlist, a series designed to bring actionable real estate investment tips straight to you, whether you're buying your first property or adding to an existing portfolio. And what better way to kick things off than by summarizing a powerful video from one of the legends in the game, Dave Meyer, head of real estate investing at BiggerPockets. Dave recently shared a video called 3% Interest Rates in 2025. This hack unlocks it, and it's packed with insights for navigating today's shifting market. If you're an investor or even just thinking about becoming one and you're not on BiggerPockets yet, get there immediately. Their free resources, calculators, forums, and expert content are second to none. Now let's take a step back and look at the big picture Dave laid out. 2025 is not 2021. It's a totally new landscape for real estate. The market has changed, interest rates are higher, affordability is tighter, and smart investors are adjusting. But while the tactics are shifting, the principles remain the same. Buy great assets at good prices, maximize your active income, and always invest with long-term mindset focused on high risk-adjusted returns. But here's the key. How do you do that in 2025 looks very different than it did 2 or 3 years ago. So let's talk about 5 tactical strategies that almost anyone can use to get ahead in 2025. Hack number 1, get offer ready ASAP. 2025 is a transitional market. Deals are out there, but they're not sitting around waiting for you to get your paperwork in order. If you want to build your portfolio this year, you need to be able to pounce the moment a good opportunity presents itself. Dave gives us 4 suggestions to be able to do just that. Number 1, build your team. You need an investor-friendly real estate agent. Yoo-hoo! One who understands how to comp correctly in today's market, where prices are volatile and not every Zestimate is your friend. Ideally, you want to buy below comps, giving yourself protection against modest price declines in the months ahead. You also need a lender, a property manager if you're holding, and a couple of contractors in your back pocket if you're doing value add. Don't wait until you have a deal in hand. Start these conversations right now. Number 2, educate yourself. Too many people start looking at properties before they understand what kind of deal they're actually looking for. Know your buy box, know your strategy, know your exit plan. Because when the right deal shows up and you're confused or hesitant, you'll freeze and someone else will grab it. Study now so you can act with confidence later. Number 3, get your financing locked in. A strong pre-approval makes your offer competitive even when you're not the highest bid. In today's market, sellers want certainty. They're watching deals fall apart left and right due to financing issues, and if you can show them you're solid, they'll often pick you over somebody else's. More earnest money, a reputable lender, clear documentation show that you're not just interested, you're serious. And number 4, benchmark constantly. This might be the most underrated move of all. Start analyzing deals regularly. Learn what an average deal looks like in your market. What's the going cap rate? What are the rents? What's the average return on a duplex in your zip code? That's your benchmark. So when you come across a listing that beats those numbers, you'll know instantly, and you'll be ready to act. You can use tools like BiggerPockets' free Bigger Deals tool, or just talk to investors or local agents, doing business in your area. The more familiar you are with your market's baseline, the faster and more confidently you'll recognize and capture a great deal. To put it simply, being offer ready is your edge in 2025. It's the difference between watching deals go by and actually building wealth. Educate yourself, build your team, secure your financing, and know your market. That's how you win this year. Hack number 2 for real estate investing in 2025, delay your renovations, aka the delayed BRRRR. What is it? A flexible, low-risk twist on the BRRRR method, buy, rehab, rent, refinance, repeat, where you delay the renovation phase until timing is ideal, often after tenants naturally move out. Why this works in 2025. Market is uncertain with possible 1% to 2% price declines. Vacancies may rise. Renovations up front equal higher risk, especially when rising holding costs and volatility. Delaying gives you optionality, cash flow, and time to plan smart upgrades. So how do you use it? Number 1, buy the right rental. Focus on properties that cash flow as is, even if they're not perfect. Number 2, keep good tenants. Don't force out tenants unnecessarily. Let leases expire naturally. Number 3, renovate gradually. When units turn over, make smart cosmetic upgrades to boost rent. And number 4, refinance later. After improving income and value over time, refinance and pull out equity. Dave shares an amazing example from his vast portfolio of a duplex he purchased for $250,000 with initial rents of $2,200 per month. He renovated each unit only after the tenants moved out, and the updated rent was $2,800 per month. The total cost of the renovation, $23,000, so everything in together would be $273,000 at this point. And with $2,800 a month for rent, you can see we're above the 1% rule, so high upside. And what is the 1% rule in real estate investing? It states that a property's monthly rent should be at least 1% of the purchase price, which he exceeded in this case. So who should use this? New investors wanting to reduce risk, out-of-state investors needing timeline flexibility, and anyone wanting to grow cash flow steadily, not frantically. So the takeaway from this 2025 strategy, being aggressive in this market doesn't mean rushing. It means staying strategic, patient, and prepared to maximize upside without forcing it. Hack number 3 for real estate investing in 2025, invest in secondary and tertiary markets. What does this mean? Target smaller, less saturated cities that still have strong fundamentals, job growth, population growth, and affordability, but haven't seen explosive price or rent appreciation yet. Why avoid the hot markets? Because we all love the big names like Austin, Nashville, Tampa, and Raleigh. It was really cool to see North Carolina get some love there. Thank you, Dave. At this point, he jumps a little bit into a more national scale, that these large cities have been magnets for migration, headlines, and investment dollars. But much of that hypergrowth is behind us. They're definitely still strong long-term plays, but in 2025, they may not offer the best deals or returns. And so where to look instead? He defines secondary and tertiary markets with examples like Colorado Springs outside of Denver, Fort Worth next to Dallas, or Longmont next to Boulder, or even tertiary markets, smaller towns on the outskirts of growing metros with rising economic activity. These markets tend to be more affordable, experiencing spillover growth from nearby economic hubs, and poised for future appreciation. So still definitely deals to be found in Wilmington, but we can absolutely see in the secondary and tertiary markets in the region just incredible deals. Now, why does this work in 2025? Affordability is the number one pressure point in today's housing market, and that's not going away soon. That means that markets that are still affordable have more room to grow. We're already seeing job growth starting in smaller metros, population shifts into areas with lower cost of living, and businesses relocating for tax breaks and cheaper labor. As job moves, people follow. As people follow, housing demand rises, and so do your rents and property values. So a couple pro tips: you don't have to invest out of state to tap into this trend. Even within your own metro area, there may be affordable towns with long-term upside. Don't choose any small city. The fundamentals still matter: jobs, population growth, infrastructure, and employer activity. So the 2025 strategy takeaway: the best deals may not be right where the spotlight shines the brightest. Instead, they're just outside of it, waiting for smart investors to see the signal before the herd catches on. Hack number 4 for real estate investing in 2025: don't buy a rental. Try owner-occupied investing instead. In today's high-cost housing environment, both renting and buying are expensive. That's the reality. But there's one path that stands out as both affordable and strategic: owner-occupied real estate investing. It may sound counterintuitive, but the best move right now might not be buying a traditional rental. It's buying something you live in. So strategy 1 is house hacking, one of BiggerPockets' favorite. This is a fundamental wealth-building strategy for investors, and it's especially powerful when housing costs are high. Here's how it works. You buy a property and live in it. You rent out the other rooms or units to offset your mortgage and expenses. Example, you can live in a single-family home, rent by the room, or buy a duplex, triplex, or fourplex and live in one room and rent the others. Why it works: It slashes your living expenses, gives you experience as a landlord, qualifies you for better owner-occupied financing, lower interest rates and down payments, and it helps you build equity while others pay your mortgage. This won't work in every market. High-cost cities like Seattle or LA may be tough, but in about 80% of the US markets, right here, it's an incredibly effective strategy. Strategy number 2, and we are definitely going to have to dive into a whole episode just on this, is called the live-in flip. And this approach combines the benefits of living in a property and flipping it for profit. So what is it? Buy a home that needs updates. Live in it while you make improvements. After 2 years minimum, sell it for a gain. Now, why is this powerful? You build equity while living in the home. You control the pace of the renovations. You do it on your own schedule. But here is the kicker. Massive tax benefits. If you live in a home for 2 out of the last 5 years, your profits up to $250,000 if you're single or $500,000 for married can be 100% tax-free. That's right, no capital gain tax on your flip. It's one of the few places in the tax code that truly rewards individual investors. Big picture, most people treat their home as an expense. You can make it an investment. Whether you're house hacking or doing a live-in flip, you're reducing costs, building equity, and positioning yourself for long-term wealth. Your home doesn't have to be a liability. Make it an asset and let it work for you. And finally, hack 5, the moment we've all been waiting for, the 3% mortgage in 2025. So how do we do it? Let's close with the hack this entire episode is named after because it's that powerful. With interest rates still hovering near 7% in 2025, one of the smartest tactics you can use is to legally assume a seller's low-rate mortgage, often as low as 3%, sometimes even 2.5% if you're really hitting that sweet spot. This isn't theoretical. Millions of homeowners are still sitting on these golden era loans from 2020 to 2022. The opportunity is real, but only if you know how to look for it. So here's how it works. You find a property with an assumable mortgage, usually an FHA, VA, or USDA loan, and you take over that seller's loan. Same interest rate, same terms, and whatever's left on the balance. You're officially put on the mortgage. This isn't a creative finance deal or subject to situation. It's legit, lender approved, and potentially a massive financial win. Of course, most of these assumable loans are for owner occupants, which is why it pairs perfectly with house hacking, live-in flips, or even short-term rental setups where you occupy the space. It's not for hands-off investors, but if you're willing to live in the property, it's a no-brainer. Think about it. If you can buy the exact same home, but pay 3% interest instead of 6.75%, you're talking hundreds, sometimes thousands of dollars in savings every single month. That's money back in your pocket to invest elsewhere. The trick is targeting the right loans, FHA, VA, USDA, and the right vintage, just like a fine wine. Here we're looking for 2020 to 2022. That's your sweet spot. Ask your agent, to help search for these. Look through listing notes and ask listing agents directly. Some sellers even advertise the assumable mortgage to sweeten the deal, but many don't. That's where doing a little extra digging gives you the edge. And yes, you might pay a little more for a property with an assumable mortgage. That's okay. If the numbers make sense and you're locking in a fixed 3% rate for the long haul, it can absolutely be worth it. This is one of those rare cases where paying a premium up front can save you tens of thousands of dollars over the life of your loan. So real estate investing in 2025 still follows the same timeless principles. Buy great assets, hold long term, and invest wisely. But the tactics, the how, have to shift with the market. Let's recap the 5 hacks Dave shared today. 1, be offer ready. 2, consider the delayed BRRRR. 3, invest in secondary and tertiary markets. 4, use an owner-occupied strategy. And 5, find an assumable mortgage. Each one is practical, proven move you can make right now to thrive in today's market. A special thanks to Dave Meyer from BiggerPockets for breaking it all down with clarity and actionable advice. If you're investing in Wilmington, North Carolina, or the surrounding deal-heavy towns like Leland, Hampstead, or Southport, subscribe for weekly updates on the best local strategies, leads, and hacks to build your portfolio smart. This is where smart money moves in 2025. Don't miss out.